You've had a good morning. 2 trades, both winners. You're up more than your daily target before lunch. And then something shifts. You take a 3rd trade, then a 4th, maybe a 5th. None of them were in your plan. All of them felt completely justified in the moment. By the end of the session, you've given back most of what you made. Sometimes all of it, sometimes more. If that pattern is familiar, this video is going to explain exactly what's happening, and it has nothing to do with greed. The pattern has a name in behavioral psychology. It's called the house money effect, and it was identified long before anyone applied it to trading. The core finding is simple. When people are operating with money they've recently gained, they treat it differently than money they started with. They take more risk. They make decisions they would never make with their original capital. In casinos, people who win early in a session consistently bet bigger in later rounds. Not because the odds changed, because the money doesn't feel real anymore. It feels like the casino's money, house money. Trading does exactly the same thing to your brain. The moment you're up on the day, your psychology shifts. The profits feel separate from your real money, and that separation is what causes the trap. Here's what the house money trap actually looks like in a trading session. You hit your daily target. Your plan says stop, but the market is moving. There's another setup forming. And your internal voice says, I'm already up. Even if this trade loses, I'm still profitable today. That sentence, even if this trade loses, I'm still profitable today, is the house money trap activating. Because what that sentence actually means is, I'm about to take a trade I wouldn't normally take, with risk management I wouldn't normally use, justified by money that doesn't feel like mine anymore. And here's what makes it so destructive. The setup might actually be valid. The trade might look good on the chart. But the decision to take it isn't coming from your strategy. It's coming from the psychological separation between your gains and your real capital. There's a second layer to the house money trap that most traders never identify. When you're trading with house money, your risk management changes without you realizing it. Position sizes get slightly larger. Stops get slightly wider. You let trades run past your target because you're already up anyway. None of these feel like mistakes in the moment. They feel like confidence. Like you're finally trading the way you should be trading, free from fear, trusting the setup. But that's not confidence. That's the house money trap making reckless decisions feel like freedom. Let me give you the real market example of how this plays out. A trader hits their target by 10 a.m. Clean execution, 2 trades exactly according to plan. They're up a solid amount, and their rule is daily target hit, session over. But the market keeps moving. A 3rd setup forms, one that genuinely looks valid. They tell themselves, I'll just take this one more. I'm already up. Worst case, I give back a little. The trade works. Now they're up even more. And the house money trap deepens. The gains feel even less real. A 4th trade, a 5th. Each one feels easier to justify than the last. By noon, the session that was a clean, profitable morning has become a full trading day. Position sizes have drifted up. Stops have been moved. 2 of the last 3 trades are losers. They end the day break even, or slightly negative, on a morning where they were solidly profitable before 10 a.m. That's not bad trading. That's the house money trap executing perfectly.
Now here's what separates traders who break this pattern
from those who don't. It's not discipline in the moment. As we discussed in the first video, trying to fight your psychology in real time under pressure is an unwinnable battle. The structural approach that tends to work is what some traders call capital unification. The idea is simple. Every dollar in your account is the same dollar. There is no house money. There is no profit buffer. There is no, "I'm already up, so this risk doesn't count." Every trade risks real capital. Every session starts fresh. The P&L from this morning does not change the value of the next dollar you put at risk. When that belief is genuinely internalized, not just intellectually understood, but actually felt, the house money trap loses most of its power. The practical structure that supports capital unification looks like this. First, a hard session rule. Not a soft guideline, a hard rule. Daily target hit means session over. No exceptions. No, just one more setup. No, the market is really moving today. Session over. This feels overly rigid until you track your data. Most traders who do track their data find that their worst performing trades almost always come after their daily target is already hit. The house money trap has a statistical fingerprint, and it shows up clearly in trade journals. Second, position size locked for the session before the session starts. Not adjusted based on how the morning went. The same size on trade 1 as on trade 5. If the morning was good, that doesn't mean trade 5 gets a bigger size. Capital unification means the size never changes based on the current P&L. Third, and this is the one most traders resist, log the trades you didn't take after hitting your target. Every session where you hit your target and stopped, note what the remaining setups would have done. Most traders who do this for 30 days discover that stopping at target was correct, more often than continuing would have been. That data is what eventually makes the hard session rule feel natural instead of restrictive. One more thing before we close. The house money trap is not about greed. That's the misdiagnosis most traders make. They think they overtrade when ahead because they're greedy, or undisciplined, or impatient. The real mechanism is psychological separation. Your brain genuinely processes recent gains differently than original capital. This isn't a character flaw. It's a documented cognitive bias that affects every human being, including professional traders. The difference is structure. Professionals build systems that account for the bias before the session starts. They don't rely on willpower to overcome it in the moment. They remove the decision entirely. That's the no backup edge approach. Not discipline, structure. This video is for educational purposes only. Nothing here constitutes financial advice. Trading involves substantial risk and is not suitable for everyone. The question I want you to sit with after this video is simple. What does your data say about your trades after your daily target is hit? If you don't have that data yet, that's your first step. Start tracking it this week. Drop your answer in the comments. And if this pattern is something you've lived through, you already know exactly what I'm talking about. And if you haven't seen the first video on the escape route bias, watch that next. These two patterns are connected in ways that will make more sense once you see both.